Well, good afternoon. My name is Rita. I'm from the Wood County Committee on Aging, and we've been doing a monthly series with Chad here. You're from Edward Jones, and he's been gracious enough to come in. We're doing a hybrid option here today, and we're focusing on stocks, right?
That's right.
All right. So let me turn it over to him. Give you a moment, and we're going to share our screen here. Yep, there you go.
All right, step one down. All right, well, appreciate it. For those viewing online, for those here, my name is Chad Plontz. I'm with Edward Jones. We actually have a location and office here in Bowling Green, 519 West Wooster Street. So we're literally walking distance from here. I did not walk though. I did try.
It's a little hot today.
Exactly. So, but as previously mentioned, this is a monthly thing that we do here. It's typically the last Tuesday of every month, where we've been doing Zoom seminars to kind of bring people up to date on just different financial topics. Hopefully, this will be the first of many going forward that we'll be able to meet with folks in person as well as the hybrid online option. So. You know, I guess kind of a caveat for today, since we are in person as well as online, typically we'll hold questions towards the end for those that are online, but we can answer questions here in person as well. Typically for a conversation like this, in terms of, we're talking, stocks, but more in general, how they work, some of the nuts and bolts of stocks. So typically, we'll try to not dive into specific company stocks or anything like that to have those conversations. So if you have questions about specific companies or specific company stock, that's something we could probably set up a one-on-one to discuss if you have a specific question about an individual stock. So, but yeah, so we'll go over a lot of good information today pertaining to stocks themselves. So I guess we'll be zooming in on the screen here. I may even jump back and forth a little bit. So really, if you're for the packet that you have here in front of you, for those online, you may have heard of the story of a group of people that were put into a room blindfolded with an elephant in the room. They were told to go ahead and touch the object. They didn't know it was an elephant, but touch the object that's in the room, right? And explain, what you're experiencing. So you kind of guess, okay, what is this, right? So there's some people, they put the blindfold on, they reached out to touch and touched the skin of the elephant, and they're, almost feels like barkish like. So they're like, oh, maybe it's a tree, right? Another person reaches out and grabs the tail, and they're like, oh, well, it feels like a rope. Maybe it's a rope, right? So that kind of, it's that idea of, right, without knowing the big picture, without knowing what it is, each person's experience can be a little bit different. So it's kind of interesting, when you talk about investing in individual stock, right, with not knowing the big picture, if you were to just pick individual stocks, it's really hard to get a grasp on if one individual stock is really representing what your big goal is, right? Just a touch of the tail or a touch of the skin, right, is not necessarily giving you the big picture, and it may lead you down a path that you didn't intend, right? So that's in terms of what you're seeing, and that's in your packet there, but you can see here on the screen. So keep it in your mind, right? I believe in investing is just a lot like this, where having the big picture is definitely beneficial. So what you're seeing here is, our 5-step process. So we do have a 5-step process when it comes to investing. Understanding, first off, where you're hoping to be today, right? Where are we today? Without knowing where you're at today in terms of investing, that makes it very hard to know where you're going, right? Roadmap, useful roadmap, you got to figure out where you're at today, right, before you can figure out where you're going to go. So, step 2 there is, where would you like to be? Do you have an destination? Do you have a goal in mind, right? And then 3 is, are you on track to get there? and pertaining to stocks in particular, right? Is the stocks that's that you own today can help you reach the goal that you're trying to achieve in the future, right? And then figuring out, okay, well, is owning that stock going to do that for me? And if not, what adjustments need to be made? Is this stock the right thing for me? Should I be getting into something else? And then, of course, step 5 is always making sure, because just because you buy something today doesn't mean it's appropriate for you forever. So, getting together and making sure that you're staying on track for the long term. All right, so the basics, right? Stock basics. The reason you're probably here today or logging on to view the Zoom is maybe you own stock, right? There's many different ways in which you could have potentially accumulated stock over years, right? It might be something that you at one point in time purchased on your own, right? It could have been something that was acquired through participation through an employer plan, right? Sometimes employer plans offer stock options, or you may have had direct stock options from an employer that you had the ability to purchase. Maybe it was an inheritance. So there's things out there that, many scenarios where maybe you are in something that you're not even familiar with, right? And that might be another reason that we're here today discussing that, to make sure that, once again, you have a better understanding of what you own, why you own it, right? And then hopefully give you some clarity on that part of it. So I guess first off, what is a stock, right? Stocks really are just, a piece of ownership in a company. So for those, people that are maybe more seasoned investors that are really looking at, reason, they want to have an opportunity to really own a piece of something, right? So typically when you talk individual stock, right? Individual stock, corporations issue stock, right? And there's many reasons where they might issue individual stock. A lot of times it's to raise more money for financing projects, obviously for growth for the company itself, pay down debt, or potentially strengthen its balance sheet. So another way that they can do those things is to borrow money. Another way is to borrow money, which is often done through really bonds. So they can issue stock, they can issue bonds. It's really the idea of loan versus own, right? Saying, are we loaning people money, or are we letting them own or have ownership in the company itself? So it's a common phrase that you may hear, the loan versus own. Stock is truly ownership, though, right? In a company. So what you're seeing on this next slide here then is the different ways that stock can be issued. So most times when you hear of a company issuing stock, where you typically see that is it's common stock is what they're typically referring to. So for common stock, it's the first type of stock a corporation would normally issue, but not all corporations do issue both. So there's common and preferred stock. So preferred stock, once again, not something that's always issued. Most cases when people talk about the stock, they're referring to common stock. Majority of all stock sold is in the form of common stock. So preferred stock is very similar to like bondholders. So they're not entitled to any. So what you're seeing on the screen here, right? They're both ownership in the company itself, right? In terms of a small piece, depending on how many shares you own. But in terms of dividend payments, right? So if you're owning a company that owns or that pays dividends, in terms of common stock, as you're seeing here on the screen, dividends can fluctuate. They can also fluctuate with preferred stock, they can. Neither one's necessarily guaranteed, right? A company could say, we're done paying dividends. So that's always an option. As you can see there, they can be eliminated at any point without notice. But preferred stock works much like bonds, where there's more of a set percentage of the stock's value that would typically be paid out in dividends. So So that's one of the differences. Common stock also, because it's ownership, and preferred stock's more like bonds where there's the own versus loan, or loan versus own, right? Preferred stock doesn't give you any type of voting rights, where common stock does. So that's one thing to keep in mind. Once again, whether or not you want to be involved in that voting option, that's another conversation altogether. So priority, right? What's the pros of having common or preferred stock? Well, priority is set with preferred stock when it comes to if a company goes through bankruptcy or liquidation, right? Because preferred stock is more like bond holders, right? They have first right at dividend payouts. So if a company goes through bankruptcy and liquidation, they're going to be paying out their dividends to bondholders and preferred stockholders. If they can't fulfill everything, that's when common stock, people that own common stock would potentially not receive any dividends if they were going through that liquidation. So that's another big area. So a little bit of information there on common versus preferred, but once again, when you do hear or look at stocks, typically what you're looking at is common stock. All right, so this next part is just how stocks make money, and in the workbooks, which obviously those online real quick won't have the workbooks, but you're probably following along the workbook here. So this is, if you just flip to page 5, and I'm not sure if you're by that one. Okay, so yeah, page 5 was just kind of a breakdown of that common versus preferred. So this next area then is how stocks make money, right? It's the potential growth of principal and dividends. So now that we know a little bit more about common and preferred stocks, and the difference between loan versus own, right? Stocks versus bonds, equities versus debt. The difference between common and preferred stock. Now we can kind of talk about how stockholders, people that actually own stock, can make a little bit of money on these stocks, right? And there's two real ways: the potential growth of principal, and the dividends, which are together referred to as your total return. So when you own a stock, the potential growth of principal, it's also capital appreciation, is a term for that. And it describes the opportunity for the stock price to increase, right? So if we go buy a stock, for example, and you pay $15 per share of a stock, well, and you go to sell it, and now the stock price is at $20 per share, that means you have $5 per share worth of growth, right? That's capital appreciation. So that's one way that stocks can grow and return, provide a return to you. The other portion is dividends, then, right? So dividends, as we touched on briefly before, between the common and preferred stocks, dividends, they're payments given to shareholders. Typically, they're going to be paid out more often than not quarterly, but first off, some stocks don't even provide dividends, so there's always that. The ones that do provide dividends, although they're not guaranteed, and they could be the dividend that is stated when you purchase the stock, could be reduced at any point, could also be increased, right? So that amount can fluctuate, but then also in addition to that, typically they're paid out quarterly, but there's even times when they're paid out once a year or maybe semi-annually. So, but once again, with dividends, it's typically a percentage. So what eventually here we'll get to a stock exercise. So we'll dive into the dividend payouts and how the yields work. But typically, if you were to just use a round number, right? And if you purchased a stock and it showed that the dividend yield was, let's use a round number, 5%, right? So if it was 5% and you owned a stock that was valued at $100, right? Well, you would receive for the year, every share you would receive $5 for that $100 share that you hold. So in however many shares, that's how much you would earn for the year, right? So, and typically, once again, if that's paid out quarterly, then we would divide that $5 or 5% divided out by the quarters of the year. So once again, that's the dividend yield, the two main ways or the two ways that stocks can actually make money for you in your portfolio. So when we talk about investment strategies, right? So we talk about types of stock, how they make money, and then now we're to the point of saying, okay, well, when it comes to my investment strategy, what are some basics, some things that we should be looking at, or important parts of the conversation? And the three things that we look at Edward Jones is quality investments that provide diversification, and we always look for a long-term perspective, right? So typically, and to be able to do that, it really comes back to that 5-step process again, right? Of saying, okay, well, where am I today? What are my goals for the future? And then how can quality, diversified, long-term investments help me reach that goal that I'm working towards, right? So the first thing being quality, right? So when you think of quality, right, what are some things that come to mind when you think about quality investments? Any thoughts at all about something that would be considered a quality investment? Not necessarily a company, but just in more generalities. Yeah, right. Longevity. Yeah, proven track record. Absolutely. Yeah. Okay. Yeah, so the quality, right? It's you're right. So in terms of stocks, right? If you think about all the stocks that are out there, I mean, there's over 65,000 stocks that trade globally. So there's a lot of things to choose from. So how are we going to narrow that search down? Well, we define quality as one that is a well-managed, right? A well-managed company with long track record of growth and performance, right? A quality company will typically share its growth with shareholders, so the dividend portion, right? And oftentimes they're sharing that growth through increasing dividends and stock appreciation, right? So not always, but many times these quality companies are leaders in their industry, right? So if we think of, I don't want to name any specific companies, but typically it's companies that are going to be, once again, ahead of their industry, companies that, as we drive down the street, we may recognize, right? So they make products and provide services you're familiar with. You see, once again, every day as you're driving down the street, they may also hold dominant positions in the industry. Another thing to think about, which tends to make it difficult for competitive newcomers to come in and kind of take over, right? So they kind of have they're firmly planted, right? So it's not something that they're going to be overtaken and may not be here tomorrow, right? So once again, more things to think about there. So why do we focus on quality? Well, quality companies historically have held their value for longer periods of time, right? Than other stocks during market declines. So when things aren't going great in terms of the markets, right? The more quality investments are going to be steadier during those downturns in the market. So, all right. So page 7 in your workbook, and you might be there all there. Yep. All right. So this is just kind of, it shows process. We first filter stocks based on geography, right? Saying, okay, what region or origin is the stock in? Longevity, once again, risk, so like credit ratings, size and quality criteria. From that group, we further narrow the field by identifying companies we believe, once again, sustainable competitive advantages in the market, experienced management teams and strong financial positions, right? Maybe very little debt on their books. So we currently at Edward Jones actually follow normally between 300 and 350 stocks that we track, and we have analysts tracking that information on a regular basis. So last we used valuation analysis to determine what's the stock price at. Is it a fair price? And then this process allows us to actually recommend whether or not we believe quality companies are actually having the attractive price to actually purchase them, right? Just because it's a great company doesn't mean you should necessarily go out and buy it. Right? If it's already overvalued in terms of the stock price itself. All right, so the next portion here is diversification, right? So, obviously the intent of diversification is really to diminish your risk by owning different types of investments, right? It's kind of the idea of, don't put all your eggs in one basket. You hear that quite a bit. So, you may, another analogy, right? You may have heard, it's not really an analogy, I guess, right? When you think of a suspension bridge, because if you're looking at the picture here on the slide, right, is, when you look at the suspension bridge, imagine if one of the cables was damaged, right? It's kind of the idea. And it's saying, well, if the bridge was made with one cable, right, and that cable was damaged, what would happen to the bridge? Well, it may collapse, right? Yeah, so it'd be a big disaster, right? So it's kind of the idea. And, if it had just one cable, that'd be a problem. And, that's why suspension bridges are made with multiple cables, right? And so if one cable is damaged, the bridge doesn't collapse, right? We have diversification. And it's very much that analogy, right, of saying diversification is much like a suspension bridge. And if one of those investments, one of those cables goes out, your entire bridge doesn't collapse. It can be held up and supported by the other suspension cables. So once again, just the analogy there. So what you're seeing here is one type of diversification, and it's owning, investments with multiple investment categories. So what you're seeing here is a pyramid. So the largest piece of the pyramid, at the bottom of the pyramid that you're seeing there, is cash, or cash equivalent types of investments. So that may be like a savings account, things like that. So it provides liquidity. Income is the next portion of the pyramid. It's the second from the bottom. So the next largest area in the income is going to be things such as CDs, bonds, right? Those are types of things that, like the name says, right, can provide income and a steady flow of income. Because the idea there is that, the principal is protected, is really the design. And there's not going to be a change in terms of capital appreciation when it comes to the CD or the bond. 100,000 that you put in remains 100,000 until the CD or bond matures, but it's providing you a consistent income until that maturity time, whether or not that's monthly, annually, however the case may be. So that's the second one. The third is growth in income. And this is where stocks tend to come into play. So growth in income are investments, and many times stocks that pay dividends, right? So they tend to have fluctuation when it comes to their capital appreciation, right? So the amount that you purchase a stock for, well, that stock price can go up or down. But in addition to that, it can provide some income too, especially if we're looking at stocks that have a proven track record of increasing their dividends from year to year, right? The percentage that they're paying to their stockholders. So not only do you have the capital appreciation option, right? That you buy a stock at 15, it can go to 20, but you also have the ability to say, well, this stock also pays 2.5% per year, right? So it provides both, and there's more stability in stocks a lot of the time in a quality stock that is in that category, because we're not just relying on the capital appreciation, and we're not just relying on the income or the dividend from it. They work together, so there tends to be maybe more even performance. The next area that you're seeing there in yellow is growth. So these oftentimes can be stocks that don't pay any dividends, right? Instead of paying dividends out to their shareholders, they may be reinvesting back into the company. So in that scenario, that can tend to make it maybe a little bit more of a volatile stock, right? When the markets are fluctuating, companies in that category may be fluctuating with it, right? So there's no dividend to kind of help it out when it comes to the shareholder, right? right? You're not receiving that income from it. So when the value's down, the value's down. You don't have the dividend helping you out on it. The other area at the very top, and it's not even appropriate for all portfolios, but aggressive investments, right? Emerging markets. So we'll get to that part here in the next slides, but it's investments that are more on the aggressive side. They're not the well-known companies out there. They tend to be companies that are going to be, once again, more emerging markets, smaller companies that are strictly looking to become those, big companies that we're so used to seeing in the normal industry. So. Another form of diversification here is by sector, right? So we talked about investment sector. Now we're talking about specific sectors of the market. So we're not talking about income, growth in income, and strictly growth or emerging markets. Now we're talking about, okay, well, if we own individual stock, what sectors of the market are we looking at, right? So as you can see, through Edward Jones, we believe a diversified portfolio, everything is not even when it comes to the sectors to be looking at, right? So you can see in terms of utilities, right? 4% of the portfolio, right? If you're going to buy individual stock, what companies fall into the utilities category? And if we're trying to build a diversified portfolio of individual stock, we would, our recommendation would normally be that 4% of the stock holdings should be in the utility sector of the market, right? Technology, as you can see, it's 25%. So once again, this is just kind of giving us an idea of the idea that, once again, not all your eggs in one basket pertaining to individual stock holdings, but also sectors of the market, right? Because if we look at different times for pullbacks in market, there's years when technology does really well, right? There's years when, pick any of these, communication services do really well, but then there's times when they're not doing well, right? So if all of our eggs are in one basket or one sector of the market, even though we might be in different companies, that sector of the market may be, not doing well. And a good example of that is the energy sector of the market last year. So, right, with everything that was going on, oil companies, right? There was a lot of issues last year when it came to that. So the energy sector of the market got beat up really bad last year. You had all your eggs in one basket in the energy sector. That may have been something you felt more than maybe somebody that was more diversified. So when we talk about balancing sectors, that previous screen showed you some percentages, but really there's, when we talk about sectors, there's your offensive sectors of the market, your defensive sector of the market. They kind of help each other off balance, right? So by proper diversification, you can really say, okay, well, the reason we have a diversified portfolio is because when consumer discretionary may be and the market's down and consumer discretionary is not performing as well, maybe the defensive investments, your healthcare or consumer staples and utilities, those are going to be sectors of the market that they have a negative correlation, which basically means, right, we don't want investments that are all going to react the same way, because when the market is down, everything is going to be down. So we do want investments that don't have direct correlation to each other. So in that regard, we do want some defensive sectors in addition to the offensive sectors to provide diversification, but then to even out the performance in the account in good times and bad when the market's up and down. So. All right, so page 11 on your worksheets. I started to get into this slightly just a moment ago, is diversification by company size. So, what you're seeing here on the screen is, and you may have heard of these references before, right? Large cap, mid cap, small cap, micro caps, and then also like emerging markets, things along those lines. So, so what you're seeing here, when we think about large cap companies, it's those companies that are, when it comes to their market capitalization, which is market capitalization is your outstanding number of shares divided by your actual stock price. So basically what you're talking about are the larger cap companies are going to be your larger companies out there, right? Their market capitalization is 9.5 billion, right? So mid cap, once again, are going to be the smaller companies that are working their way up. Typically, your mid cap and small cap companies are not going to be big dividend payers, right? They're still trying to become those large cap companies as well. The large cap companies is where you do typically find your more consistent dividend payers. Micro cap, once again, less than 500 million. Micro cap also includes stocks trading under $4 a share, which you start to get down, right? Penny stocks, things like that as well. So some of the companies that maybe you're wondering if they'll even be around, right? It's, they can be very volatile stocks at that point. All right. So let's walk through a couple of simplified diversification examples real quick. So we talked about diversification by sector of the market, benefit of owning stocks in different sectors. Their performance may not be directly correlated to one another. So for example, once again, technology and consumer staples are two sectors that are not directly correlated. So let's say you own one stock in each. I went over this a moment ago, but the idea of, well, if tech stock declines at the same time, the price of the consumer staple stock may be on the rise. So that's what this slide is illustrating, is that we don't want to see both of these lines going in the down direction at the same point. That's where you're going to find some, once again, no direct correlation when it comes to performance, and can help even out the performance of a portfolio. All right, so here's another example. So let's say all of your investments are doing fine. One, however, is consistently doing better than others, right? So, so what you're seeing here is, stock D, right? Just in terms of letters, stock D. So what do you think will happen to your portfolio? In this scenario, remember that you made the decision to carry a certain amount of each sector based on risk tolerance, right? So we want to spread out, different sectors of the market. So while it's great to own one stock that has done really well, right, it may start to get overweight, right? So that may result in additional risks, right? Now we're overweighted in that company. It's more of our portfolio. So technically there's a couple of different things you could do, right? You could first, add money to your portfolio. So we're going to add money to your portfolio and just start, buying more of the stocks that you are underweight at this point, right? You see the dotted line there. That's kind of our weighting scale. So you could just add new money, right? Purchase additional stock that's already, or new stock that you don't own, or you have the ability to sell some of stock D, right? The idea of sell high, buy low, right? So if the stock's doing really well, it's kind of against, almost feels like it's against human nature, right? To say, hey, this investment's doing really good. Well, let's get rid of it, right? But it's, what's that? Yeah, but sure, yeah, every stock is different, right? But the idea is, you want to be able to capture some growth from time to time, right? So, like I said, it's kind of against human nature, or our nature, to say if something's doing really well, let's get rid of it and go buy something that's not doing very well at the moment that we believe in for the future, right? The idea of sell high and buy low. In theory, it's great, and that's why many people work with advisors to be able to because once again, investing has a lot to do with emotion, right? So yeah, a lot of times you say, oh man, what's the hot stock right now? Well, if you go online and look at stocks that are already up 30-40% for the year, right? Is that the right time to be buying, right? Or have they already, would you have rather, let's find the stock that's down right now, but have the potential to be up 30-40%, right? So, once again, diversification example and just outperforming the rest, when you have investments that do that, this is obviously showing the diversification and rebalancing, selling some of stock D to move to purchase more stock F, which obviously was down in this scenario, right? But we believe in long term, right? We're not going out and just buying something that's going to beat up, or there's reasons for it being beat up. Yep. Well, that would depend on the type of an account it's in, because different types of accounts, vehicles. So in a traditional IRA, it wouldn't make a difference, right? If you're in a traditional IRA, you're not taxed on. You're not going to be taxed until you take the money out of the account. If you were to sell something and buy something else inside of your 401k or your traditional IRA, there's no tax implication for that, right? Until you take the money out. In a Roth IRA, if it's in a Roth, those are 100% tax free at a certain point when you take the money out. So, there may not be taxes based on transaction there. If it's in, excuse me, a taxable account, yes, there could be tax implications to placing trades like that. So that's always where you want to, speak with your tax person, but your advisor should be able to provide you at least insight, know the right questions to be looking at when it comes to that. But once again, it kind of gets back to what kind of account are those investments in? So, because it could be a scenario where you wouldn't have a tax situation. All right. Any other questions about that at all? No. Okay. All right. So page 12, I think. Yeah. Next page for you, page 12. So if we circle back on the concept of rising income, right? We've mentioned rising dividend payers at this point. Stocks that may have consistently increased their dividend over time. So the idea is rising income, right? So rising income refers to your income from investments that pay dividends, but have the potential to increase dividends over time. So it's hard to say exactly how much milk and eggs and bread and everything's going to be in the future. But excuse me, if inflation stays around its historic average, the price almost of everything you buy will double in about 25 years. Is kind of the idea. If inflation numbers stay at their average. So to get an idea on how much you can see on for you here, page 12 of your workbook. While fixed income can play a role, and I suppose that's probably about the same page. Yep. Okay. So you can kind of see in terms of over 25-year period, right? 1994 to 2019. What the average price of the car was, right? What was the average cost to fill up a tank of gas, 17 gallons, right? Month of groceries, annual health care expenses. So that's 1994 to 2019. So if inflation stays the course, which in recent months, right, it's kind of creeped up, but it gives us an idea of what 2044 might look like, right? Tank of gas, fill up a 17-gallon tank in 2044. It could be as much as $85 to do that, and so on. So that's really where where are we going to get that additional income from? And it can come from your investments, right? So it doesn't necessarily have to be the fixed income, the bonds and CDs. Yes, those are there for income, but keeping in mind that stocks can provide that extra income as well. So once again, just another thing to think about when it comes to the investments and how is it going to generate income for you in the future. So this next part is long-term perspective, right? So at Edward Jones, we believe developing a long-term goal, long-term perspective for your finances is important, right? Your goal is to find quality companies that, in the right amounts and hold those investments for a long period of time. It doesn't necessarily mean you're going to buy them and forget about them, right? But the idea is, let's not look for investments that can get us rich overnight. Let's look for, strong quality investments that can provide income and return potential over the long term. All right, so this really starts to get to, when we talk about long-term perspective, time in the market is better than trying to time the market. So this gives you basically a hypothetical. And what this is showing you is, in this scenario, if somebody were to take an investment of $10,000 and invested it in an index on the S&P 500, right? S&P 500 index in December 31st of 1979, right? And if they just held that investment until October of 2020, you can see that $10,000 over that period of time would have turned into $883,952. And all they did was put $10,000 into the S&P 500 index at that point and never did anything, right? Now, we were trying to time the market and say, okay, well, we're being pretty aggressive, right? All of our money's in the S&P 500. But we said, okay, the tech bubble happened in 2000, 2001, right? Financial and housing crisis happened in 08 and 09. Last year with the pandemic, the market was down 34%. If all of these different scenarios, and there's always something that comes up for major pullbacks and corrections happen on a regular basis, there's always things that happen in the market that cause fluctuation and pullbacks in the market. It's a normal part of the market. So this is basically showing that, well, if you were somebody that was trying to time the market and all these different things happen throughout history, and you said, okay, well, we're getting out of the market now, and we're going to get back in 6 months or whatever, right? Well, if you had over that period of time, right? So we're talking over the basically 40 years, right? Over a 40-year period, if you missed just 10 of the best trading days over a 40-year period, you would have made, instead of 883,000, 394,000 by missing only 10 days out of 40 years by trying to time the market. If you somehow stayed out of the market even longer, right, and you missed 20 of those days, now you're down to 229. And if you're missed the top 50 days, right, over that 40-year period, your 10,000 after 40 years would have only been worth 63,000, even though you may have been invested for all of those days other than the top 50. So pretty significant. There has been research that actually has shown that, and it may have been updated by now, but at a certain point in time, there was a study that was done that showed that the 20 best trading days over the 40 years, once again, this is a little bit outdated, 2020. We're in July of 2021 now. But the best 20 trading days in market history during that period of time happened within 30 days of the 20 worst. So the 20 worst trading days during that period, if you stayed out of the market for more than a month, you would have missed the 20 best trading days after that, right? So it's the idea that, once again, let's not try and time things. You can see the significance of even buying and holding and the return potential there. the S&P over that time, 11.62%. So disciplined approach, right? That's where having a process in place really comes into play, right? When it comes to investing, do you and your advisor have a process in place to say, okay, when things go, get bad, right? What is our process, right? Do we know where we're at today? Do we know where we're trying to be in the future with our goals? And are we currently on track, right? Having that 5-step process that we have helps our clients through that. Hopefully you're in a similar situation, that you have somebody that you can work with. And then systematic investing, right? This from the approach. The systematic investing, dollar cost averaging, allowing those types of things to, once again, not to have to worry about trying to time the market, right? If you can just systematically put money away. And this really breaks down that lump sum, trying to time the market, right? Of saying, well, I have $5,000 that I want to invest, but I'm going to try and wait until I think the market drops before I, put that $5,000 to work, right? So in this slide, it's basically showing that if you just took a lump sum of 5,000 and versus the dollar cost averaging. And what dollar cost averaging is the idea of systematically putting in the same amount on a consistent basis, whether or not that's monthly, each paycheck, whatever the case may be, right? Because what you're seeing here then is if on the slide, the average price per share, right? If you just took the 5,000 and threw it in, you don't know if you're buying at the high, the mid, somewhere in the middle. Dollar cost averaging, well, if you're putting it in each month in this scenario, right, there is going to be times when the market's going to be at its highs when you're putting the $417 in, but there's also going to be times when it's at the market low and you're buying more shares at that point, right? So obviously this is just for illustration purposes, but this is kind of the idea of, if you took the same type of fluctuation that happened in the lump sum, the same type of fluctuation that happened dollar cost averaging, that with the dollar cost averaging, your average price per share would end up being lower. So now, of course, right, if you happen to time it right, you pick it at the very low, right, you put all $5,000 in with the market, the shares were at $12 a share, that's different, but it's, once again, are we going to be able to time it perfectly every time if we're just hoping to try and time the market each time as opposed to systematically and dollar cost averaging? Other ways to own stock, right? So this is basically, we like the idea of owning stock, but maybe we don't want to have to worry about what individual companies to purchase. How can I like the idea of having exposure, having company A. I like the idea of owning a piece of company A, right? I really like that company, but I don't want to just go out and buy that one company. Or I have $10,000 to invest, but I don't necessarily know if that's going to be enough to go out and buy enough stock to be diversified. What other options do you have? Mutual funds and ETFs. So what you're seeing here then with mutual funds are a way of diversification. They're a managed product, which basically means think of a mutual fund as a shopping cart, right? And somebody's pushing that shopping cart down the aisle. And that person pushing the shopping cart down the aisle is looking to make the world's best chili, right? Well, there's all kinds of different chilies, sweet chili, spicy chili, white chicken chili. There's all kinds of different chilies, right? Well, there's other people trying to make that exact same chili as everybody else. So there's a bunch of different mutual funds out there that are trying to achieve the exact same results. But the person pushing that cart gets to pick the ingredients that they want to go in so they can make the best, sweet chili, right? So, and all the rest of the people are pushing carts too, trying to make the best sweet chili in their mind, right? So, but the idea is you're picking all these ingredients, you're picking all these individual stocks to put in your basket to try and achieve the result that you're looking for. So they can pick and choose and whichever they want, right? So it provides diversification. You can kind of lump your your investment in to their basket to try and achieve the returns that they're returning. Mutual funds are a managed product. They're designed to outperform the sector of the market, right? They're trying to outperform everybody else. ETFs are more designed, once again, they provide diversification, but they're more designed to somewhat mirror the market. The idea is that we're not trying to outperform, we're trying to mirror the market. So other ways to own individual, take ownership of stock in those types of investments as well. And questions on any of those at all? So once again, back to the mutual funds and ETFs, passive versus active. Passive investments are exchange traded funds, ETFs. They're passive because once again, they're likely to perform close to the index, right? They're mirroring the index, where active is the opportunity. Somebody's actively managing it as opposed to just passive investment that doesn't have any management to it. So that's what that's showing there. So I know we covered lots of information here today about stocks, the different types of stocks, right? How can they make money? The principles of just stock investing, what makes a quality investment, what provides diversification, and why you should be looking for a long-term perspective when it comes to investments, and then the different types of investments you can get into. So that's where we'll stop the presentation here for today in terms of the online stuff. So I'm going to figure out whether or not I can do this. So let's